Hi, Warriors. Alexander, David, Mary. How's everybody doing today?
Good morning,
Morning,
Dale.
Dale.
Good morning,
Good
everybody.
morning. Hey, Ryan.
Hey, mate.
Kman, how are you guys?
Good.
Have a good
Nice long
weekend?
Yeah, nice long one for some. Holiday for me.
Okay. Can you guys see my charts?
Yep.
So we may as well start with cable that's lighting it up today. Fundamentals for it. I know that Friday came in, talked about it rallying one big figure, was kind of a standout. What do you think? Cable
Well, yeah,
going to start to outperform, getting this pullback.
Today.
What's that?
It did it again today. We started the early day below 125 in cable and then made it up to, well, roughly the highest where we are now, 125, 70, 75. There was a bit to do with the gilts and the UK rates, which are seemingly taking more importance than what's happening on the political front. There's a few trying to price at least a 50 BP hike by the Bank of England before the end of the year, and I think that has a bit to do with the bounces that sterling is having for now. I'm not a big believer, but they are what they are, and they are there. So.
Okay, so if you're not a big believer, is this rally that we've had from 21 and a half? You have any sell ideas where you might consider it?
Yeah, the other week I was showing 126.50.80 to me is a very important, a pretty important zone. I'm a little short, but it's really not in size wise. It's really not a big size. I will remain flexible. If 125.90.95 goes, I may be out and then try it again 126.5 zone.
Yeah. Ryan, your thoughts?
Yeah, pretty much in agreement. I don't know if you've heard the news, but there's going to be a no confidence vote on Boris this evening. I don't expect it to be huge impact, maybe outside some knee-jerk news if he wins, loses, or wins by a big or small margin. It is a leadership contest, not a change of government, so everything will be as is with a new leader. So, but look out for some choppiness in the pound in the latter part of the UK European day.
Is one of the reasons for no confidence Boris's haircut that looks like he put a bowl over his head?
No comment.
I mean, that was a haircut in, I think, the 20s or something, but I was wondering if that had anything to do with it and, why he was invited to all these parties for entertainment.
I can't comment on haircuts, Dale.
Okay. All right. Well,
I'll leave it to you.
Huh?
I'll leave haircuts to you, mate.
All right. Well, I'm just saying from this side of the pond, the haircut's outstanding. So metals, especially silver, flying, and the gold-silver ratio is crashing today. So, I mean, this looks like a descending triangle in the gold-silver ratio here from, 83, 89, at 6.
How do you use this ratio, Dale, just for people who don't know?
Okay, well, when this ratio is going up, it's showing that gold has more relative strength than silver, and most real big bull markets happen with silver leading. So when this is coming down, gold is a weakness, and silver is your preferred long. So that's like euro pound. When euro pound's going up, it's the same thing, and that's how you use it. And precious metal bulls like to see this come in. There's some people talking about eventually, I remember when I had an IB and stuff, gold silver ratio normal for, my time as a broker was about 40. Okay. And then we went all the way up to above 100 here. And then you could tell on the weekly, this 82 level is important. Looks like it broke out, and back underneath it opens the door. And, you could see it in silver up 2% and gold up 0.2% today. So,
yeah, gotcha.
And S&Ps, as we had the a 38 or 43 debate going on, which happens first. And as long as we hold this 4,100 level,
that's the biggie, isn't it?
yeah, look at that. And the way it closed Friday, how how would you have known to go home long or just came in when it was maybe up a couple earlier? What lit it up?
I think maybe a bit of China news that they're easing their restrictions over there, flights opening up, that sort of thing.
In fact, we had a guest, and he's pretty good, a Dem, radical Dem, and he does like contrarian option trades. And last time before it was the dollar, when people were not bullish the dollar, and he went with China, and you know, it doesn't look too bad. Here's the F.A.C.E. So, you know, with the lockdowns and everything, put in a nice bottom, looks like to me.
Yeah, same in dollar one. If you look at that.
Oh yeah, and you guys were there. Yeah, you guys were there at the bottom.
Kman was. I was trying to line up at the top, but missed it. I was looking at 680 to get back in just before I went away. Never got that high. And,
okay, so
I waved the boat goodbye off the dock.
Okay, so in a little bit of a pullback mode, maybe this is a break to buy in the yuan. Although, you know, with what's going on with Russia, you know, people are, I think you could buy oil from him with yuan. So
yeah,
maybe that's what's strengthening the yuan here, right? But it looks like the trend has changed, maybe long term here, right? That's a hell of an impulsive move.
Yeah, we couldn't get up towards those recent highs, even for a test, which I was looking for, and it does look like it's heading back down. I'm not sure we go all the way back down to the 630s, 640s unless we get some, you know, they stop easing and, you know, the economy starts picking up. But the pressure's off for the moment. Yeah. You know, we had that from the Chinese state. Some of their branches saying, you know, it's not going to be a one-way trip higher in dollar one, and that proved to be the top.
That's right. Nice call. And yields, guys. I mean, the yen didn't make a new high. Either have yields. Looks like they might try 3% here. Don't you think they want to go for the stops over 131 in U.S. dollar yen? Just
I've started building a short. I'm been short from 127.40 up to 130.80. So
it's 31.34 as a stop up here. Okay.
Yeah, and that 3% I think is going to be important in tens.
Okay, and look, I think if we make a new high in the yen, it's not going to confirm. And you know, I'm sure there's going to be some dollar short covering in front of the Fed next week. Mm-hmm. So the yen could make a new high. I don't think the Dixie will. You know, maybe it could go to 3.5 or so, 4. But between the two, what's your preferred short? I mean, would you rather short the yen at new highs, or would you rather short the Dixie on a failing rally?
Well, I can only trade dollar yen, so that'll be my preference.
Okay, all right. Or you could, you know, use euro instead of.
Or you could go neither one of them and be long Canada yen like I am.
Yeah, skip it all together.
Canada here.
The strongest versus the weakest for the time being, I'd say within the major, at least the G7 or G11 currencies.
You're right. So the commodity currencies.
Mm-hmm. Yeah.
Okay. I still think there's somewhat of a correction coming in Aussie. I don't think it's just going to launch. Look where it's stalled. So maybe we get a pullback to 71 or so.
We'll know soon enough. In 12-14 hours, we got RBA.
That's right.
If they do 25 or 50, I think that's going to send the Aussie a 1.5% away from where we are right now, in my opinion.
Okay, so what, 100 pips
Yeah,
the upside.
something that, yeah.
At 25, would it do it? Or do you need the
25
50?
would disappoint the markets a little, in my opinion. But
Depends the message that comes with it.
yeah, that's it.
If they only hike 25, but say it's 50 next month, then
Yeah, but they won't say that.
No, I'm just saying, that's the sort of thing that will change a disappointment from just a 25 pip hike if there's a hawkish message alongside it.
WTI 135 first or 106? Huh?
You love giving yourself a head start on those, don't you, there?
It's an easy over under, isn't it? Let's see, 150 or 115.20. What do you think? Which one's coming first? That's probably still 135. Anyway, so I don't know. Stel, good morning to you. Are you around?
Stelios is not around. He's and by the way, you guys didn't grab a beer with Stelios while he was there in London?
He was in London.
I was in Ireland.
Yeah, he went to the Queen concert this weekend.
Yeah,
and he didn't look you guys up for a beer?
No, that was the right question to ask. It's not,
a scumbag.
To go to London, it's for him to come and visit us.
I know. I think it's the biggest crock of crap, and you guys should give him hell when he gets back today, in my opinion. Anyway, good morning, everybody. So I'm going to step in for Stelios. Good morning, Coach.
How are you, buddy?
I'm awake. It's Monday. How are you doing?
It is hard to roll out on Monday.
It is. Mondays are always difficult. They are difficult. It's like you spend Saturday and Sunday, regulating your sleep, and then Monday comes around.
Do you know what they're doing here? They're doing a test. I think 3,000 workers they've put on a 4-day week on the same wages to see if it increases productivity. Unfortunately,
really? I bet it would. I 100% bet it will. I think a 4-day work week would be great.
Yeah, but we'd just be crap on a Tuesday instead of on a Monday.
Yeah, that's true. But I would really prefer a 4-day work week. I think it'd be great. Working 12-hour days, because I already work 15-hour days. So if I could just shorten the number of days that I do that, it'd be great. Hey, Ryan, welcome back. By the way, I know you had to go out of town for personal reasons, but welcome back.
Thank you very much.
Yeah,
bit of a holiday as well.
What's that?
It was a bit of a holiday as well.
Oh, good. No, that's awesome. Well, we have not had a holiday in the markets unless you're a bull. So how do you guys feel about this rally, Dale? Remember last week we talked 4,300 or 3,800, and everybody thought everybody thinks 3,800. I'm wondering if everybody's still feeling that same way.
And look, Bitcoin is now hitching its wagon. For a few days, it wasn't participating with the NASDAQ 100, but today.
I think Bitcoin's really trying to weasel its way up there, and I wouldn't be surprised if we see 35,000 before lower prices as well. So
kind of delinked for a few days, and people were going, well, not even that correlation works. So it keeps hitching its wagon, or at least the owners of it keep giving different reasons for it. But
well, hey, by the way, just FYI, I'll pull it up. Gold and silver just actually hit highs. I know you guys were talking a little bit earlier about the gold silver ratio, but here's gold intraday. We just popped through some little resistance. Here's silver, trying to break higher as well. And you look at silver, this has been like a slow moving inverted head and shoulder pattern, just trying to see it move higher. But I tell you what, it's really starting to firm up here, and we can really get a little bit of a squeeze if we make it above the 200
3.5 24 is a big area.
It's a 50% retracement here, 50 DMA. But you were talking about the Aussie. I wanted to bring that up really quick because I do believe that we are at a lot of resistance. But Dale, you thought that the Aussie might have to pull back a little bit. I'll tell you where it did pivot today is it hit the trend line, the ascending trend line here. So
nice look.
Yeah, as long as we stay above like today's lows, I don't know if I'd really want to be on the short side and bet against, these central banks right now raising rates. I mean,
yeah.
I know we have the ECB this week. That's going to be the big one. And do you guys have any feelings on the ECB, Ryan and Kman? I know you guys met on the Flow show earlier today. Did you have any thoughts regarding the ECB?
Yeah, we've got to remember that this meeting isn't about any action. It's about setting up what they do in July.
Right. So what are they going to do with like PEP and the other acronym facilities that they've got?
Well, the PEP's over because that was the emergency thing.
But they moved that into what else?
Yeah, they're crossing some into QE, into the APP, whatever they want to call it. So, we obviously know from what we've been told from, 100 ECB heads, what they're going to be doing, stopping QE 1st of July, then raising rates at their July meeting 21st, and then again in September. That's the ballpark where we're at. So it really depends on what Lagarde's going to do Thursday to set that up. Is it going to be, we're going to do all that, plus give us something for the future? So, we're not going to stop at 2 hikes. We're going to keep 50 bips on the table like all the other central banks. Or is it going to be not, I wouldn't call it dovish, but less hawkish, where she says, we're going to do that, but we're not going to pre-commit to hiking in July or September, or we're going to hike July but not September. We're not going to pre-commit to all this stuff. And the market maybe takes that a little bit disappointingly. So I think there is twofold risk for this one. The fact of the matter is the ECB are going to be hiking. I think that's definite. It's just how the market takes, how they're going to hike, and what they're going to do with QE. Are they going to make an announcement on whether they're going to draw it all down? Do QT and that sort of stuff. Are they going to kick that can? Is it going to be long drawn out process? So I think that if any disappointment dip is maybe worth looking at for a buy. But then if we get some hawkish news and we go with a break, you've got to be careful not to get too tied in with the announcement comments. The first few lines we get at 12:45, because then you have to wait for the press conference in case she there dials things down a bit, and then we see a pop reverse. So it's one of the ones you got to play as you go along, but look for that second wind. If they're hawkish at the start, and then we see the price drift lower during the presser, and nothing changes from that, look for the second wind after the ECB, because that's the move you may want to jump on.
I mean, how many naysayers are out there that really didn't believe that the ECB would actually ever raise rates? And I mean, still probably don't. So, as they march towards, doing something next month, and they prep the market for it, I mean, it could really set up for an explosive move higher in the euro. Don't you guys think?
Yeah, very much so.
Yeah. Okay. So I think the euro, so many people were just talk about like the euro in general. So many people were talking about parity and about, the euro's finished, it's done. I think the risk is the euro makes it back to the 200-day moving average, back up towards 112. So I think we got to watch the euro very, very carefully this week. And speaking of, the euro going higher, one of the things that's going to give the euro a little bit of a boost is that S&P. We talked a lot about the S&P really, being able to stage a little bit of a rally here, and that could really help out, risk appetite just in general. And then Dale, you brought up Bitcoin. I mean, you look at Bitcoin. Everybody's targeting, Bitcoin's going to break down, and here we go to 20,000. What if Bitcoin breaks at 32,000 and we trade up to 35,000? The underside of all this broken, technicals. I mean, that seems like it's possible. Yeah. Ethereum.
All the S&Ps go to 4,400.
Yeah, I mean, the S&P we're currently targeting 4,300, but look, the S&P could very easily go back and see the 200-day moving average. With China coming out of lockdowns, I mean, that's generally speaking pretty good news for stocks, right? I mean, by the way, I went to go. We had to replace our oven. We had like one of those wall oven microwave combo thing. You know what I mean?
Oh,
ours completely just crap the bed. And
I'm
so,
surprised you know what one looks like.
What's that?
I said, I'm surprised you know what one looks like.
Yeah, no, I mean, look, we had to go grab one. Not only have they doubled in price the last time I looked, but they're out of stock. Like you have to put one on order for like 6 to 12 months away. It's crazy.
Wow.
Yeah, it's really wild. So there's still a lot of supply chain issues that are ravaging through like
everything.
I mean, that's just an example, because I had never even thought that would be an issue.
Think about buying one till it poops out.
Yeah, and then I'm literally at one of the larger electronics retail places, and they're like, yeah. I'm like, how about that one? I'll take that one. Well, that one's, there's 54 people waiting on that particular model, and here's our shipments coming in. And he was showing me like we're getting 30 like in this next quarter, then we're getting another 22 here.
Where are they coming?
So you'll be on like number 60 on the list, so you should get yours by the end of 2022. I'm like, jeez. What? Really? So anyway, just crazy.
You have to use barbecue for the time being.
You know what? Which I have no problem doing. Let's just make sure we get that straight. But anyway, I just wanted to say that China lockdowns, as they come out of lockdowns, that's a good thing. And going back to the Aussie dollar, Dale, you pointed out the Aussie, the 200-day moving average. Yeah, big resistance. Also big horizontal resistance, but technically, if we break above 72.75, we should go higher. And after, the false breakdown below 70 cents, I mean, it's.
So what do you do, Blake? You wait for after the RBA, or do you get positioned in front of it?
Well, I have the ability. Well, I was long overnight, and I just, got long again. So, because I know where my risk is at. My risk is, while we're above that, 71.80 level, that's I know that I want to be on the long side. However, I'm looking to add post RBA. Now, I have the ability to do that, and you do too, being in North America. You just kind of got to stay up a little late. But I know, poor Kman and Kman, and I've seen you do it before. He'll get up in the middle of the night to actually trade the RBA, but it's tough, if you're in European hours, right?
Mm-hmm. Yeah.
He was in a dream state.
Come again?
You were in a dream state when you were trading.
Sleepwalk
into a trade.
Sometimes it's a nightmare.
Yeah. Well, hey, I wanted to say that, to address your question, Dale, I think with the RBA, it really is, as those guys pointed out a little earlier, it's based on, what we're going to hear from the RBA and how hawkish they might be. But, a break above the 71 or 72, 75 level, it's going to be a breakout. And we have to be cognizant that there's a 618 retracement just above it at 73.25. But I think this is very doable for this week, following the RBA. I think that levels can be tested. And, there's a lot of people are probably short that continue to fade the Aussie. So, why can't it continue higher? Right.
The good thing about trading is, even if you're not around for these moves, if you get a break us that 73 up area, high 72, 73 area, you don't have to chase it. If you're lucky, you sit, have some patience. If you get a test of that and nothing's changed, there's your level to lean against.
Yeah,
73, 72, 75. If you get a move there, you try along, and you don't have to be a hero about it. 30, 40 pip stop, something like that, and maybe you catch the wave higher.
Yeah. I mean, I think there's a lot of different ways to trade the Aussie, but I'll tell you what, and this is, I want to shift gears a little bit. How about this? How about this yen? You know, I heard you say, Kman, the Canadian yen. I mean, how do you fade that? That broke out at. Well, yeah, well, you don't. I'm just saying.
I would say.
No, I mean, we closed the week in breakout territory. I made a stink about this on the week ahead video, but I mean, we closed above the 618 retracement. We closed in, breakout territory. Why? I mean, this thing is bullish. It's about as bullish as they come.
Yeah, absolutely. It's as I was saying, it's currently the most hawkish versus the most dovish, and the most hawkish has an extra tailwind, which is extremely high energy prices, and which are not coming off, and commodity prices. So there is a lot to go for this pair right now, and yeah, we can see pullbacks. No, nothing goes ever one direction. But the break looks extremely strong, and now it's already bid around 103, 102.90, I'd say.
Yeah, and I'm wanting to buy the dollar yen. I keep looking for pullbacks to buy this thing, and I didn't take advantage of it last night. But let me pull it up really quick. The dollar yen, I think, still looks very bullish here. And we got bull flag after bull flag after bull flag developing, and I know we talked about this on Friday after the jobs report, or before the jobs report, looking at that bull flag. Some of you might have picked it up on Friday after this show, but yeah, I mean, it looks like we're going to break this 130, 135, and when that happens, when or if that happens. What do you do with the dollar yen here? I mean, it held 126 support, which I had a lot of buy orders down there and never got triggered, which is irritating in itself. But what do you do with the dollar yen if it spent the last 3 weeks consolidating above resistance? Does that mean we have to chase it higher? What do you guys think?
I'm a little long from after the job data on Friday, as the people in the room know, because we update everything in there live. I'm not going to chase or add much to it if it would break above this 130, 140, 35.40 again, but maybe a little add-on, and then just keep that level very close to the chest. But it's if we look at the overall move, we are just in a higher volatility environment, but we are just consolidating.
Yeah. All right. Well, it's interesting to say that you don't want to add to it. I don't know. I just look at it as it has spent, like I said, about a month, maybe more. Since, let's call it, actually the breakout was right here since mid-April. So we spent 2 months really consolidating these gains. I mean, if you're not pulling back, usually there's only one other direction to go. If it's not going to go down, it may just continue to go higher. So I don't know. I might actually end up chasing this one higher. Hey, real quick, Ryan, I know you mentioned Can I
just add one on the yen? The only one that can really change this whole thing is the Bank of Japan. That's of course the only one that we have to really monitor. But all speakers last week were like, no, we are not really going to change much right now. But
right, and so they're the Bank of Japan, really, they're not changing their path at all. No. And until they become more hawkish, which, I mean, if you've been watching, the BOJ over the last 20 some odd years, they don't really do that. Anyway, so thanks, Kman. Hey, I was just going to say regarding this no confidence vote in the UK for Boris Johnson. I heard what you said a little bit earlier, but is there any way that Boris Johnson steps down as prime minister? Is there any way that happens?
Yeah, potentially. That'll be a factor on the margin. you know, how if he wins, by how much he wins. If it's they're looking at he needs over 2/3. Anything over 2/3, then it's seen as a strong win. Anything less than that, it's seen weaker. And people
but is that why the sterling is up so aggressively this morning?
No, I think it's on the same yield story.
Okay.
We had a little pop, you know, first thing this morning, which it was only the pound that popped. So that looked like the usual model 8 a.m. man that we watch for in the mornings. But we did see that moving in gilts. But yeah, if he doesn't get a big margin, the pressure will be on him to resign.
Get another haircut.
It's the same as what happened with Theresa May. I think she lasted about a month after she won her vote before she stepped down, because the people who don't have confidence in him will just carry on bashing away at it.
So it'll be interesting. And I know, and by the way, Dale, I know you have interview with Jamie from Reuters. And by the way, and you guys should stick around and listen to his interview. Probably one of my more favorite journalists in the markets out there.
Oh, you said that to Pedro. Which one is it?
I like them both. Those guys are both like, they're legacy dudes. They've been around forever.
All right, I say that too.
But it's, you know, as somebody who's been, you know, reading financial articles since the 90s, you know, really just kind of plugged into, you know, the Bloomberg, Reuters, CNBC genre of, you know, since the 90s for me, since the you know, mid 90s really.
How about Steve Leeson?
I'm a fan of very few journalists, and you know, I love Pedro da Costa. He's awesome, and Jamie McGeever.
We have the dynamic duo in the rotation.
Yeah, I just mispronounced his name. Jamie McGeever is going to be awesome. Is he this week? Do you have Pedro da Costa on?
No, but they're in the. You know, I reached out to Pedro's coming back.
Okay, so, cool. Well, I know you have this. I know you have this interview starting right now. I just wanted to say that I think a lot of people might be caught short the sterling, and you know, maybe we don't get the reaction that a lot of people would believe on a no contest vote. You know, or let's say Boris steps down. You know, a lot of people may think that, oh, well, that's negative for sterling, but I don't know. We have a pretty bullish setup technically here, and I don't know if I'd really want to be short if we start breaking above like 127. Anyway, I just wanted to bring that up. I think technically it looks like it's setting up for a move higher. But Dale, I want to say, have a great interview. Kman,
you need to help because I can't promote him.
I'll hook you up. But I want to say, Kman, thank you for all the help last week. Ryan, welcome back. Nice to have you back in the saddle, you guys.
Thank you very much.
Yeah,
and well done, Kman.
Yeah, next man up came in was last week.
And let me go find Mr. McGeever here.
Okay,
so,
it is now.
What's that?
Now he is.
Is he? Yeah. He's oh, good. Good. I'll let you go. All right. Thanks, everyone. Have a great day, and we'll catch you guys tomorrow.
Cheers, guys.
Okay. Jamie, welcome back to F.A.C.E. You have fans here?
I heard. Very kind words. How much did you pay them?
Well, we don't. We have shills. We have shills that work for free here, Jamie. Okay.
1 second.
Anyway, great to have you back, Jamie. And
great to be here. Thank you very much.
Yeah. So I wanted to start off with some of the things I've read in your feed, and you're talking about the terminal rate. And maybe you could explain to our viewers what is the terminal rate and how the forecast has been changing lately.
Yeah, well, the terminal rate is what we call, or what we deem to be the, excuse me, slight cough, is what we deem to be the rate at which the Fed will raise the federal funds policy rate over the course, basically the peak rate of the tightening cycle. And that's obviously hugely important for financial markets because it tells you how quickly the Fed will tighten, how aggressive or not, and when that rate will be reached according to market expectations. And obviously these expectations shift. They move quite quickly, sometimes very rapidly indeed. And basically, what I've been looking at is not just the level of the terminal rate, but when it will be reached in the eyes of the US money markets, and also the looking beyond the terminal rate as to when the market thinks the Fed might start easing policy. And it's been quite interesting since the Fed's decision, policy decision in May, in early May. We have seen on that day, I think it was May the 4th, the FOMC day, the terminal rate as implied by SOFR contracts spiked to 3.48%. Let's call that 3.5%. So that day, the market was thinking the Fed was going to raise rates to 3.5%. And the timing of that was deemed to be around about June, September next year. Since then, it's been very interesting that the implied rate, again, this is all just implied what the market is betting on, and we obviously don't know. The implied rate has since fallen, and it fell as low as about 2.8% in late May, and we're now hovering around 3.2%. So you can imply from that since the Fed's meeting last month, the market has removed about 25 basis points of tightening in the cycle. And interestingly, as I said there, that terminal, the timing of when that terminal rate, or when the Fed would peak in its tightening, was deemed to be around about September, June, Q2, Q3 next year. That has gradually been pulled back to June, a very firm bet on June. And actually, in the last week, 10 days or so, there was a very brief moment where the March implied contract, with implied rate for March 2023, was higher than the June. So basically inferring that the Fed would actually peak in March. Now that's quite a rapid sort of tightening of the cycle. It's a shortening of the length of the tightening cycle. So if you think that the Fed is going to be in max out in March next year, that's very important for financial markets. And the back end of next year, we started to see a widening of the spread between March and June versus December. In effect, the market is now pricing that the Fed will reach peak rate round about just above 3%, sort of the middle of next year, and actually almost fully priced in a cut of 25 basis points in the back end of next year. Now, take from that what you will. To me, that shows to me that the market is buying into the Fed narrative that they're going to press ahead with rate hikes in the short term, but the price of that will be, it will be paid in terms of the growth outlook. And recession risk is still quite small, but I think the market is starting to price in the likelihood that growth will certainly slow. If not, the economy could tip into recession, and the Fed will be forced to cut in the second half of next year.
Okay, so is it possible that the Fed is just playing catch up with a 10-year rate that already traded 320?
Yes, most certainly. But as you've also seen from the 10-year, the 10 years didn't stay up at 320 for long, did it?
No, that's
what I mean. It hasn't stayed above 3% for long. I think we're back down at 295 or so. We certainly were on Friday. 297
now.
297. Well, screen. Yeah. And the curve has started to steepen slightly. I think last I looked, we're about 27, 28 basis points in the 2s, 10s. So, I mean, some positive sloping in the yield curve is now back in play, and it has been for a few weeks. But again, you may not want to read too much into that in terms of the growth outlook and future Fed policy, because as we all know, the curve inverted, however briefly and shallowly, if that's a word, in early April, I think it was. We got about 5, 6, 7 basis points of inversion over a couple of days, and boom, we were back positive again. But as we all know, despite some of the protestations from Fed officials, including Jerome Powell, that the 2s, 10s is no longer a leading indicator anymore, certainly in the current environment of major central bank stimulus.
If they don't like the message, they change the indicator.
They did. Powell focused on, I think it was the spread between the sort of 3-month rate and the implied 3-month rate over the next 18 months. So a very short-term snapshot of the curve. He preferred to look at that. Other Fed economists in working papers have put out papers saying that maybe the 3 month 10-year is a more accurate guide. But you know, facts are facts. The 2s 10s has been pretty reliable over the last 40, 50 years.
Yeah,
ignore it at your peril. I think we discussed this last time as well. I would say ignore it at your peril. This time it may be different, but it may not be.
You know, and bond is a big word, right, Jamie? And I bond, because there's so many different stripes of bonds. And I was wondering if you could help me with this and tell me if my interpretation is correct. I see the sovereigns here, using TLT as a proxy, looking to be the weakest. They had the weakest rebound here, followed by the corporates, which had a better bounce and are holding up here. And surprising to me, the one with the best relative strength is high yield or junk. Is this saying that we're probably okay for risk on for a while, or this would be underperforming sovereigns and corporates, that the high yield market is getting the bigger bid? Much bigger bid than treasuries. Here's the treasuries, much bigger bid than treasuries and corporates. What's the message with high yield being the relative strength of debt?
Well, it typically, as you know, in times of you know, growth risks and downdrafts across asset markets, credit gets hit pretty hard, and especially high yield. And high yield is usually one of the first to go. That hasn't been the case this time, as you point out. I think last I looked, US high yield was, I think the spread was only around 400 basis points.
Yeah.
And, you know, historically speaking, that's not much at all, is it? And that spread of 400 or so is only around 140, 150 bips above the cycle tights. So that would suggest that certainly as far as the credit market is going in high yield, there's very little recession risk being priced in there, and there's it seems to be giving you a bullish signal, and certainly risk on. But the flip side to that would be maybe these growth expectations haven't been priced in yet. Even on the short-term rates contracts and the bond market and the treasury market, as we were just discussing, yes, 25 basis points of easing is being priced in for the back end of next year, but it's not being fully priced. And it's only 25 basis points. So you could argue that maybe, you know, the market is not going, you know, all in on a US economic slowdown and a major response from the Fed.
Yeah, I found that interesting. Yeah, just the price action, that it had so much more energy than.
Yeah, no, I think it's been quite remarkable the way that the high yield market has held up. You know, that may start to shift as growth and earnings expectations maybe get revised down. Perhaps these earnings expectations and default risk expectations are still too optimistic. The fact there was a note from HSBC out this morning just talking about that, and they were saying that, well, their argument was that you should probably focus on the downside risks to growth and earnings over the more attractive valuations. Now you can, you know, you pay your money, you take your choice.
I've heard they haven't really priced in the earnings reductions, which they believe are compression, that part of the decline.
Well, it's interesting on the earnings, on the valuations. There's no doubt that they're much more attractive now than they were 2 or 3 weeks ago.
Valuations, yes.
Stock market equity valuations. S&P forward 12-month Ps are, I think they're back in line with, you know, the 10-year average, and they're below the 5-year average, which might suggest, you know, now's the time to get back in. But then you have to bear in mind also that the last 5 years, they haven't been a normal 5 years, shall we say. We've had major fiscal stimulus and Fed stimulus, and that was even pre-COVID. And then throw on top of that the huge double whammy of stimulus in the pandemic over the last 2 years. So maybe you shouldn't be comparing your 5-year average to the last 5 years, because it's been a very abnormal 5 years.
I'd say 99.9% of analysts and traders out there are calling this a bear market rally, and maybe, you know, we go to 43, 44. I would say the lone wolf, any lone wolves out there are saying that we may put in the bottom or go into new highs. I don't hear anyone talking like that anymore. Do you?
It's hard to say. I think it's safe to say, obviously without naming names, that equity strategists are famous for clinging on to their views until the last possible second. I mean, I remember at the start of the year, in sort of January, obviously when all the big shops were putting out their year ahead outlooks, they were pretty much to a man and a woman bullish on the S&P. It was not super bullish, but 10-15% gains forecast for the year. And as Fed's hiking expectations, think back to January when we had Jamie Dimon and Bank of America coming out with 7 rate hike calls. I mean, many people thought they were off their rockers, but here we are. 7 that proved to be accurate. As those tightening expectations got priced into the money market curves, the rate curves in the bond market, equity strategists still held on to their bullish, 10% gains for Wall Street until it was patently obvious that April
was the decider.
I think so.
So
they'll be the last ones to
turn bullish again.
Probably. I mean, if they've gone bearish or drawn back their bullish calls now in the last couple of months, I think it'll be sometime before they flip back again.
Yeah. Okay. And is the U.S. your beat or global beat? Could you comment on what you think the RBA might do this week?
I think the RBA, like everyone else, is in full-on hiking mode and inflation fighting territory. I mean, yes, my beat is global and but US being the focus, of course. But I think you mentioned it in your discussion before I came on. What's super interesting for markets this week will be the ECB now. And again, one of your panelists before was talking about people not believing that the ECB would ever hike rates ever again. And as you also said, I've been doing this. I've been around the block for a few years, and yes, that was the vibe, that was the narrative, and it built up when Draghi, they said he'll do whatever it takes. They cut rates to zero, then they cut rates to negative. Trillions of QE and monetary stimulus, and there was a deflation problem or the risk of deflation in the Eurozone. Obviously, that's completely flipped in the last 6 months or year. And they're now facing an inflation problem. And this is very much uncharted waters for the ECB. And dare I say, much of the market trading it. Do you believe the ECB when they say they will raise rates by 25 or 50 basis points? For veterans in the market, that's a very hard pill to swallow, because
the market still doesn't believe Lagarde will do it, do they?
I don't think so, and I think there's good reason for that. There's very good reason for that. Those of us who were around in 2008, July 2008, and 2011, I think it was, when they tried to do it again, tried to raise. These were, history has shown that to be, by some estimations, some of the biggest policy errors in the last 10, 20 years. And so, if you were around then, do you think that they will, go for third time lucky? They may have to, just because of the inflation problem, but they will not be doing this easily.
Okay, so that's going to be a real big tell for the market here. Do you think that what we've had here so far, Jamie, in the dollar, we had a pretty nice pullback, just like we've had a nice rally in euro. Are you feeling a shift that maybe the dollar might be losing its interest rate differential edge as part of this?
That follows seamlessly from what we just talked about there, the ECB. I mean, some of the pricing, the money market pricing into the Eurozone curve for this year is nothing short of remarkable. 130 odd basis points of tightening priced in by the end of the year. Bank of America today saying they expect 150. I mean, for a central bank that, as we just said, has been guilty of perhaps two of the biggest policy errors in recent central bank history, they've been at negative rates for years and years and years. To suddenly go from that to 150 bips of tightening in the teeth of what may well be an economic
recession because of the energy issues.
The energy issues, the geopolitical issues right on its doorstep. I mean, that's a pretty bold call. I think that's a pretty bold call. Will they follow through? No, only time will tell. But I think some of that pricing may come off in the second half of this year, in the back end of the year. However, we are where we are, and there's no doubt that part of that dollar pause that you just mentioned, it's definitely lost a bit of steam. Maybe that was always going to be on the cards. It was at a 20-year high on an index basis only a few weeks ago, and so if you compare, I think all the Fed tightening, as we also discussed, has been priced into the curve. Now next year we're starting to price in a Fed easing, and the ECB has gone in the opposite direction. We're now pricing in aggressive tightening. So that explains why maybe we didn't get down to parity, and we're probably just as close to 115 as we are to 1-to-1 with the dollar now. I think we're in a kind of wait and see mode on both the dollar and the euro in terms of central bank direction. I think the ECB is the big one this week. They won't do anything, of course, but they'll lay clear foundations for their policy path for the second half of the year. And
do you think
will they be as aggressive? I think it's absolutely fascinating. I'm still not sure. Maybe once bitten, twice shy, and all that. But I would be surprised if they follow through with, say, 150 basis points of tightening in 6 months. That would be remarkable.
Okay, so still believe that it's just words and actions are different than words. So
as we all know, central banks have to talk tough on inflation, and part of their job owning and their guidance maybe let some of the market do the work for it. If they get the euro back up to 110 or above, I think one of your panelists said maybe 112 might be on the cards. If they get the euro up to 112, then that's nearly 10 big figures higher than when it was only 2 or 3 weeks ago. And I think they'll be quite happy with that. Obviously, the inflation dampening effects that has, and the signal it sends is, I think they would be happy with that.
How about the Fed? Would the Fed embrace a weaker dollar? I know that many multinationals that started talking about the strong dollar being a headwind on profits would welcome it. Would the Fed welcome a weaker dollar? Embrace it?
Welcome or embrace might be a little bit strong, but I mean,
give it a kiss.
I don't think they would object if the dollar was to come down, say 5%, 5% from where we are now. And again, it was only a few weeks ago that the dollar, on an index basis against the world's major currencies, was at a 20-year high. So, some sort of if some steam comes out of that balloon, then I don't think that will do the Fed any harm. And I think the dollar was so strong in the last few weeks that I think the G7. I think we had the G7 summit a couple of weeks ago, where I think they mentioned in the communique a commitment to. I think they did mention foreign exchange rates. There was some speculation building going into that policy meeting, that G7 meeting, that the Japanese certainly would press Yellen and Powell on the dollar. And I think behind closed doors,
talk about the yen. We're almost at new highs after, which means a weaker yen, right? And it correlates pretty tightly with the 10-year yield, right? And the 10-year yield doesn't have the same energy. Here's a 10-year yield. See, the rally is not as advanced as much. I'm thinking maybe 3%. I'm not looking for new highs. And the yen is only about 50 pips away from new highs in US dollar yen, new lows in the yen. So do you foresee anything coming out of the Bank of Japan that could change, what their stance has been for decades?
Well, again, I think one of your panelists referenced it earlier, and if we think that the ECB is famous for easy policy and being ultra cautious and trying to not tighten too quickly or too aggressively in the face of past policy, what can you say about the Japanese? I mean, they're the masters. They've been doing this for 20 plus years. Well, I think.
Is there a problem with it getting this weak?
Well, it's inflationary, but
Right.
I suppose that's what they want to a certain extent. They want to generate some inflation. I think.
Okay.
It's not just the Japanese, of course. All the central banks are in the same boat now. It's a complete 180-degree turn from the past, 10, 12 years. They want inflation, and they want a stronger currency. They want higher rates to try and to damp down inflationary pressure, certainly in the Eurozone and in the US and the UK. Japan's slightly different, of course. But I wouldn't bet against the Bank of Japan. If the Bank of Japan said it's going to double down on yield curve control and keep policy easy, I wouldn't bet against that. And obviously, the FX trade there is go long dollar yen. However, dollar yen's had a pretty good run in the last 6 months, and it might be to go long at 130.
A little late to the party,
possibly.
Yeah. How about energy? WTI. The Biden administration's trying to patch things up with the Saudis. They came out with they'll pump another 2, and then Russia comes out and says they're going to cut production. We haven't made new highs for a long time. The majority of people would say, new highs coming, 135. Is there anything that politically OPEC and, actually walk the talk, actions louder than words, where they could come in, and if they come in and raise production, that other countries might, to take this crude back down to the bottom of the base now? Is there anything in your on your radar, Jamie, that says there is a possibility for WTI to sell off? Or is it all one way?
Well, obviously, the more supply comes on the market, the obvious pressure on that on the price would be to push it lower. But I don't really see that just yet. I'm just looking at a chart now of WTI over the course of the last 6 months, 9 months. It looks pretty much. I'm no chartist, but what I see in front of me is a very bullish chart. And I don't see any pullback that we've seen in the last 6-9 months has been very brief. There was that pullback round about, from what, 140 odd? Sorry, about 130 down to about 115. Then it went back up pretty rapidly. I think if OPEC does come out, I'm not sure of how much capacity it has to increase output, but I think the pressures are certainly on the spot market. I think the pressures are pointing upwards in price still. However, from a macro point of view, it doesn't
demand destruction.
Well, that's true, and we've seen. I think here in the States we've got all-time high average gas prices. That's bound to bite, and that's bound to have an impact on demand going forward. And if the economy does slow in the second half of the year, early next year, as people expect, and that's going to weigh on prices too. But from an inflationary point of view, even if oil does stay up about $100, $110, $120 a barrel for the next 6-12 months, the inflationary impact on that aren't going to be particularly strong, because that's where the price has been for the last 6 months. So the increase has kind of flattened out. Right. So policymakers won't be as concerned with these high oil prices from an inflationary point of view over the next 12-18 months as they might be from a demand point of view.
Okay. Jamie, your forecast for what the Fed's going to do next week and forward guidance?
Well, I think they've all been. They were all out last week, weren't they? Daly, Mester, I can't remember who else. I think Brainard was the most interesting, perhaps. Being vice chair, she said she wouldn't rule out. I think I'm right in saying she said she wouldn't rule out a hike in September, and because Atlanta Fed President Raphael Bostic, he'd suggested that they might pause in September. Brainard, obviously one of the biggest doves on the committee, she said there's not much. She doesn't see a case for a pause, and she would press ahead with a hike in September.
Will 50, there be a surprise of 75?
Well, this is it. we've not had a 75 basis point hike since 1994, and before that was 1984. So it's near 175 basis point hike in what, nearly 30 years.
Yeah.
It would be a brave call to say 75. I think all the messaging, all the signaling is for 50 at the next meeting and the next one. And then we'll wait and see. However, if I think the balance of risks would be certainly towards 75 as opposed to 25 over the next 2 meetings. But I'm still, again, going back to the SOFR implied pricing. That hasn't changed much. As I said, the peak terminal rate was 350 for the middle of next year. That has come down since the Fed meeting in May. That's come down. I think that's worth bearing in mind. So while the Fed's talking very aggressive, it's looking like it's going to be more of a 1994-95 hiking cycle. Very short, pretty aggressive, but maybe over 12 months, say, for example, 18 months max.
Okay.
But that will, as I said, the price of that will be in growth. And we've had, even Jay Powell has said, he's gone from saying we're confident of a soft landing to a soft-ish landing. And his last comments were, there may be some pain, quote unquote. So I think he's
put on your crash helmet.
So right. I think it's quite clear that the Fed is going to go ahead, tighten, try to get inflation under control, inflation expectations under control, but be warned, the risk of that, or the price of that, will be some economic, and in his words, pain.
Pain. Okay, well, I have a doctor. His last name's Payne, Payne. Actually, so Jamie, I really appreciate your time, and people, viewers watching live, if you really want to know what's happening economically and with the Fed, and as you can see, Jamie covers everything. Follow him on Twitter at Reuters Jamie McGeever. Thank you so much for your time. We covered a lot of ground in half an hour.
Thank you very much, Dale. A pleasure to be on, and all the very best.
Okay, we'll be doing it again, everyone. People are thanking you, Jamie. Appreciate your giving spirit to share your views, and I know that you do a lot of work to come up with your insights and what you write about. So it's not easy being, gathering information the way you do it. Thank you very much.
Appreciate it. Thanks again. Speak soon.
All right, Jamie McGeever, everyone. Have a great day. You're welcome, Ann. Karsten, thank you. Jordan, and you could join the team in 13 minutes on the Morning Edge. We'll see everyone for Turnaround Tuesday. And remember, don't just count your pips, count your blessings. See you all tomorrow. Adios, and thanks again, Jamie McGeever.
Ciao. Have a good day, everybody. Bye.
Hey, buddy.